Welcome to our episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Dave Codrea. He has over 20 years of experience in real estate investing, beginning with acquiring rental homes in Pennsylvania and continuing through a career in financial consulting. Dave co-founded Greenleaf Capital in 2008, an Atlanta-based real estate investment firm. Since then, Dave has led over 125 buy-side transactions and nearly 55 exits. Greenleaf has acquired over 4,000 multifamily units and 2 million square feet of medical, industrial, and net lease assets across Georgia, Tennessee, North Carolina, and South Carolina. So Dave, thank you so much for coming on the show today.
Yeah, excited to be here. Thanks for having me.
So you have many decades of experience in real estate investing, and then you were also doing financial consulting. Can you tell us a little bit about yourself, both personally and professionally, prior to launching Greenleaf in 2008?
Yeah, 20 years kind of goes quickly, which is crazy. But 2008 was really kind of the middle of probably the start of the Great Recession kind of mentality. And the South, real estate prices were pretty cheap all over the South. And I was living in the Northeast and I was like, man, I can buy a lot more if I just go to the Southeast and the weather's a little bit nicer. So moved down to Atlanta. I was like, I'll just start, there wasn't like a massive macro strategy applied other than, it's a little bit warmer and stuff was cheaper. So I could get in and be active and like actually get started at a meaningful level. I lived in Washington, D.C. for a while and prices were 20x what they were in, Georgia. So it was, the reality of like, hey, I can come to Atlanta. I can get some stuff going right now. I can get some deals. I can get in the market and start working. And the South has always been, very population growth oriented and easy to do business in. So it was a natural, like, hey, you want to start a business? This is a great place to do it.
I think when people throw around 2008, I began investing in multifamily in 2006. I'm originally from Connecticut, and it was something that 2008, I don't think people understand if they weren't in it of what happened. And I bought my second property October 1st, 2008. And it was literally like a few weeks after Lehman went down. And it was literally like a month and a half before Bernie Madoff's thing. It was like literally if you if you weren't worried about your blood pressure and you had like CNBC on or whatever, and you're watching this thing, it was literally every half hour something was blowing up. They stop, what it's like, I can't remember. It's like the mortgage company stops lending in these towns or in this, and like somebody shut off like all of lending in this part and then Wachovia and this, like the whole thing, Washington Mutual. I mean, everything just like changed. It was a bloodbath, you know what I mean? And people I was buying properties from were over the last couple of years, and, agents completely out of the business by the time this happened. I mean, it was just so for you starting a real estate investment firm, I didn't know any better. I was just a few years out of college. But the thing though is that for people that were like, people must have thought, people were crazy if they knew anything what was happening.
Yeah, this stuff was not like a sexy, exciting thing to be doing from like 2008 to 2013. A lot of the stuff was just pure train wrecks of deals that you were looking at and being like, why would anyone ever even buy that thing? It's like, well, when things aren't going well is a lot of the time when you should be getting in and trying to figure out what can I do here. So I really like that view of it. When I started, I liked the physical building, like what can we do to improve it? I could see that progress was being made. A lot of these things are however you choose to, lead your career and what you plan to get into. I want to be able to see like what are the results. And for me, it was easy to see in real estate when I would get a basically burnt out, crappy building and fix it up and be like, wow, this is someone's home now. It's nice. That was exciting. I, felt good doing that. So that's a lot of the reason why I got into it and why I wanted to be doing it.
Did you have any kind of mentors or anything else that kind of assisted you with the whole process of buying properties? Or was it kind of just, you just did it and see what happened?
I mean, a lot of it was just kind of like do it and see what happens. But along the way, it's kind of like you got to sucker in some people to go try this experiment with you if you're just getting started. So I was lucky enough. I had two friends that started with, and they were willing to get their hands dirty and help figure stuff out and do a ton of the maintenance, rent collections, fixing laundry machines, doing all that stuff from day one. We did everything. It was just us. So it was a fun way of doing it. But I was lucky enough. I had two other buddies that said, "Hey, we'll do this with you. This sounds like fun."
Interesting. So can you give us kind of an overview of what you're doing now? So like, what is your current investment criteria and strategy at Greenleaf Management? And what are the asset classes? Because it's pretty wide ranging. You're not just on one asset class. I think there's like 3 different asset classes and markets you guys focus on.
Correct. Yeah, we have a good number of what I would call tenant types at this point. We have, we can look at them as different asset classes, but a lot of times we're buying a very similar building. For the most part, we invest solely in the Southeast from a criteria. We are typically buying more suburban type assets. They're almost always garden style with lots of parking. Whether it's an office building or an apartment, it's going to have a lot of parking. It's going to be 1 or 2 stories at the most is really what we look at doing. We don't want to have a lot of common area. That applies to office. That applies to retail. That applies to apartments. We don't really do common area in like big amenity packages. We want to have like the most direct, affordable asset that we can buy. That's really where we focus. A lot of what we've been doing lately is buying really vacant single-story office and converting it into not necessarily like a specific asset type, but something that's usable, right? We'll take a 40,000 square foot, essentially vacant office building that has a lot of parking, it has great access, has a lot of room. It's 1 story, so it's not anything crazy we got to go deal with. And we'll divide that into, call it 8 suites. And sometimes those get built out into office. Sometimes they have a roll-up door where there's a more flex tenant in it. But we also have medical users that have it. We just built out an after-school center that's in one of them. So it's a bunch of different users, but the core of it is still really the same. We're investing in the same geography because it's really population growth oriented. We want a single-story building. We want lots of parking, easy to get into. Those kind of core factors are all the same. And then over the years, we've just adjusted our leasing and build-out teams to who can we find that can best occupy this space. So that's really where we're at now. And the bulk of acquisitions we're doing right now are more that 4,000 to 5,000 square foot tenant that is operating a business out of it.
Yeah, no, that's a lot of great information. The other thing too, I found when you were explaining that is that you're avoiding kind of that functional obsolescence, right? Because you can't add. Most instances, you can't add more parking. I mean, there's a lot of, they've already tried that over the years. If you have a property that's built 30, 40, 50 years ago, you know what I mean? They've maxed that parking out, and that's something you just can't add easily. You know what I mean? And then, or if all, and like you said, the common areas, easy access, stuff like that. Again, another thing that's extremely expensive to change, to edit, to renovate. You know what I mean? And could really kill your numbers if you don't have that. So it seems like you've really got it honed in of exactly what works for you guys.
Yeah, and when you come up to a building, for us, most times like, hey, there's like 10 spots right here. You park in any one of those and just walk right in the door. Most of our stuff, a lot of stuff, if we're buying old, one of them is really like old call centers. They have great parking ratios to total square foot numbers, right? So you've got 4 or 5 parking spots per 1,000 square feet. It is the South. People are driving everywhere here. And there's plenty of parking. So it makes it just removes one of those barriers. It's like, hey, I don't want to have to go into a parking garage and find a parking spot, then take an elevator over to this other. Like we're not doing any of that stuff. That's like to me, that's like a different world of operating on those assets.
So when you're buying these assets, you said a couple things that kind of turn a red light for me was that first of all, they're vacant. Number one, where are you buying them from? You're buying them directly from a bank, or I imagine they're from a bank or a previous REIT or something like this.
Yeah, most of the time. Most of the time we're buying it from a prior real estate owner, but it could be, hey, there was a tenant here for 20 years and then they left, or it was a business that owned the building and they've shifted gears. They're doing something else. They're moving to a bigger or different space. And then this space becomes available that we buy. Most of the deals that I target are really less than $20 million. So these are not big institutional products. The buildings are, call it 30 to 50,000 square feet. So a lot of times you have someone that was in there running 1 or 2 businesses and they've either sold that and moved or shifted gears of that business and this space becomes available. Yeah, and we don't try and buy like directly from people. We're not like out cold calling, trying to drum that up. It's just been much more effective for us if we have a broker involved. And everyone talks about broker commissions and the costs and all that stuff. Yes, but it enables us to actually move a little bit quicker when we know we have someone that wants to transact, so we can buy something.
So once you're buying a property, one of the things, or before you buy it, this is one thing that I because with multifamily, it's pretty easy to sense the demand. Okay. You know what I mean? You can go on a lot of different websites. You can figure out exactly what that demand is for the vintage, for the rent amounts that I need to hit, what other things are renting for, everything like that. How are you sensing demand before you buy in these properties? And are you, when you're going and finding a tenant, is it at that point that they're telling you I need 8,000 square feet, or are you already subdividing that and then finding tenants for whether it's an office or whether it's like a flex office, industrial type situation?
Yeah. So that demand forecasting, when we have so many different types of tenants, is definitely a challenge. We look at it first on the supply side. You just pull up any like LoopNet and you're like, okay, how many spaces are available for lease between 2 and 7,000 square feet in this little pocket? And a lot of times the answer is none. So it's not like we need a huge demand of tenants. Like sometimes the supply is literally none. So we can add 3 or 4, and then there's that amount of, that's an easy demand curve to figure out there. But we also go then on the tenant rep side and reach out to tenant rep brokers that we are constantly speaking with. And a lot of times tenants have multiple locations. If you have like a lab corp or some training facilities or even after school care or autism centers, like these places all have multiple locations that they know they want to be in these rough areas. So a lot of those are just direct conversations to make sure like, hey, is there demand in this area for a, call it, 3 to 7,000 square foot suite? And when we divide them up, we are trying to divide up based on like what walls and what support structures are in place. So we're not really doing like a custom division. So that for us is the most cost effective. That's a big factor for us, is being cost efficient up front, where it's like, these are the most efficient ways we can divide this building up. And then you may have a tenant that needs 4,500 square feet, but you got a 5,000 square foot space. You're like, well, ultimately we want to make a deal and get things occupied. So we'll just work to do that. They'll have the 5,000 square foot space.
When you're working with people and they want to expand into an area and you're speaking directly to those business operators, those owners, does this also work with like franchises? Obviously you mentioned like, medical chains, stuff like that, which that might be doing, like I would think like a Quest Diagnostics type thing, right?
Oh, exactly. Quest or LabCorp, like we have a lot of those locations, and I mean, they're really geographically specific of where they are and what the facility is that they need to be able to operate out of. One, you have to have a lot of parking just to get in and out. They have drop-offs. If you can help them have a secure drop-off, that's a big benefit for them. It just makes their business easier. Roll-up doors help and how you outfit that. So there's a lot that goes into, working with those types of tenants. But there's a lot of franchise. I mean, personal fitness, pest control, these are all franchise, mostly franchise models that are out there and rapidly growing.
So when we're talking about vacant office space, there's been, I think, buzz over the last couple of years in regards to transforming office space into multifamily, which sounds great when I say it. But however, when you look at it, or if anybody's recently been in an office building, they'll realize that it's nowhere near the shell that's required for multifamily. You know what I mean? Where you have no windows, most of it, and you can't just like divide up. And every time you've been in a place, I was in a hotel that was transformed from an old office a couple of weeks back. It was very nicely done. However, you can definitely tell it's nowhere near the same. You know what I mean? And it's great that you're transforming these spaces, but also I feel it's a little bit unrealistic, right? So can you tell us a little bit about the possibility of these properties ever being rezoned to residential? Is that actually a feasible model? Or is it, if it happened, are they just like all coming down to the ground and then being rebuilt?
It was, couple points on that. Like the rezoning of stuff is hard. Like trying to say that you're going to take a piece of property in a city or an area and you're going to just rezone this one little piece of it. If I'm a mayor or I'm running a city, like that doesn't make a lot of sense. Like we already had a plan of what we wanted to see our city look like. And you're going to come in and try and just change that like for just one part of it. Now, if you go in with like a whole master plan and work with the city on doing something like that, sure, I can see that, I can see that happening. But it's hard to just say like, hey, I'm just going to rezone this one thing and it's not going to be cohesive with what the city structure is. That sounds like you're fighting an uphill battle. And we're not doing that at any of our assets. We're most of the time keeping our zoning that's in place that allows for flexible use and doing something with it. But in real estate in general, if we look at like the bigger issues going on in real estate, where you have like very large office complexes that could be converted to something, or even vacant malls that could be converted to something, or old factories that are going to be converted to something. Some of those are really neat projects. Those are just at a different dollar scale than anything, we're working on at Greenleaf, where you have, just major redevelopment stuff that's happened. Even like New York, like the Chelsea Pier stuff, or in Atlanta, we have Ponce City Market, which is just a phenomenally cool project that they did that added, hundreds of thousands of square feet of retail, apartments, office, all in one space. Very cool project. I like seeing that stuff. I don't know if I'd necessarily want to sign on for a 15-year redevelopment play. So, but we're not looking to rezone any of our stuff. We like the zoning we have. We like the use it has, and that enables us to work with like a LabCorp or a Quest Diagnostics or training or pest control companies to get them in there.
Yeah. And the other thing too is it's not just office going to multifamily. I think that there's issues. I think when I hear people talking about very cavalier, talking about, motels or hotels going into multifamily, and you're like, hold on here. I mean, there is completely different like plumbing, electrical, you know what I mean? Like it is every time I speak to people, and when I've spoken to contractors that have actually done it, they're like, the amount of like infrastructure where like just the mechanicals that have to go into that, I mean, makes it very cost prohibitive. So when I hear that, I'm always a little hesitant about signing on to that project in the sense of like understanding what they're doing, because I feel that a lot of it just doesn't make sense.
Yeah, I would agree with that. The only way I really see it making sense is if the building you're talking about has some kind of historical significance or something about it that like it's in an amazing location, or it's just like an irreplaceable facade, those kind of things where it's like this is an iconic location, an asset, and it's always going to have a use. There's that. But the random office building that's in like suburban somewhere, converting that to apartments, that's not going to happen. Or at least that would be my prediction. That's not going to happen. But the very cool stuff, there'll always be. The thing I mentioned here in Atlanta, Ponce City Market, I mean, it was an old Sears factory. At one point, I think it was the largest brick building in the country. It's an amazing looking building. There's always going to be a use for something like that people will be creative and execute on.
Yeah, I think my first office I was in Connecticut, I had for my company, was like, it was in an old factory that they had changed into offices. And part of it was still like flex space. And part of it was, I mean, this thing was massive. It had like 28 acres of like factory floor. But they'd done little by little, they were doing it over. And it was just a very unique thing. You know what I mean? Like, I mean, it was like 25-foot ceilings. It was a very cool, unique project, but they weren't going into residential. You know what I mean? It's a much easier thing when you're like, oh, we're going from industrial to, still keeping some of the industrial flex space kind of stuff. And then we're doing some of this into office. And that's much different, I think, because the other thing too is like the rezoning part of it is that, we're talking about like the dynamic of the town, but also, you have to think that some of the most expensive cost for a town is really education and then like your fire and police, right? And when you start putting in residential, you know what I mean? You're just adding to that education piece because there's, people that are going in that have to go to school and stuff like that. And it really offsets, I guess, the trajectory of that area of what it initially was set for. So there's so many different like things outside of just what we're talking about is like running mechanicals. You know what I mean?
Yep. It's very much like an institutional level play to be doing stuff like that. And even then there's, some of these things, like there's not really a track record of doing it at scale, effectively, economically. None of those things are really there. So it would just take that's a big bet to take and go try and like build all those skill sets out for an asset that even if you do a good job, you can still tell that it's probably nicer to just build it from the ground up, residential, and be in there.
Yeah, especially with all the amenities and stuff you can add in there, you'll get probably a better return on investment. Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. You talked about investing in call centers and kind of how you like them, which sounds like they're usually one floor, maybe two floors, plenty of parking, because usually people are like in like cubby spaces making these calls, I would imagine.
Yeah.
Or were. So tell us kind of like when you're searching for these properties, you're going in there, you're putting in your idea of, hey, this is going to be, we're going to split this up depending on what we feel the demand's going to be. And then we bring that to the market, whether it's directly to companies that we know that are expanding, or are you also finding tenants? I mean, I know you handle a lot of the property manager yourself. You're doing all the leasing yourself in-house as well?
I mean, we have a full property management team. You know, one of kind of like the caveats of real estate investing is as soon as you buy something, then it's yours. You've got to go figure out like what's going to happen on a daily basis. So we operate everything ourselves. We have a full leasing team, but we're also working with tenant reps and even brokers on our side all the time with all of our deals. So that's a mix of it. I really like the call center component. When I say that, it's an easy way to be like, look, the specs of a building that a call center was in when they were the tenant are really good for what we want to do. Typically, it is a one-story building. Typically, they have really high parking ratios. Typically, it has great power supply. And typically, it's in a more suburban location. So that's a lot of like, to sum up, like, hey, if you're going to look for stuff, if it's an old call center, that's really like, that kind of summarizes all the main points we want to look for in a deal. Because that's what we're looking for when we say, we want we want a building. It's more, hey, have you noticed any like old call centers that are vacant? You're like, oh, I know where there's one like that. Perfect. That's kind of like now let's go check that out, see what we can do there.
So I one time was in talks to buy a call center like in 2009. I didn't know anything about it. I did know that when I went down to the basement, they had asbestos all over the place, and that kind of scared me. I didn't know what to do with any of that. So tell me about when you're buying a property, because this is what it is. I mean, we're buying properties that are probably built in the 60s, right? 70s, something like this. Different building materials, let's just say, were utilized, which can be extremely dangerous, hazardous, expensive to deal with, whatever you want to call them. How are you guys dealing with them during during any inspection, and how this is working with what you're doing?
Yeah, on the office type assets that we're converting in, if they have any of that stuff, that's really a deal breaker for us, because the remediation effort and the time and the logistics, it just takes too long for us to get from acquisition to stabilization. So if it has some big remediation effort, that's not something that we're going to do. So we wouldn't go through on that transaction. A lot of our stuff that we're buying on that front is more like early 90s to 2010 range. When you look at stuff, and for the most part, they're all brick, lots of glass windows on the outside, but not basements, no asbestos issues, no, like, all good power, all good mechanicals that are already in place. That just making sure we have that helps us get to our conversion and get to market that much faster.
I think when you kind of block out anything pre-1985 or 1990, you really minimize all of those different building items and materials that were utilized. And that can include like lead pipes, that include aluminum wire, all this different stuff that really was utilized, I think, in the 70s and 80s, stab lock, electrical, all that stuff. That kind of, you don't have to really deal with newer properties. So that's one way of dealing with it, is kind of like marking it out of your buy box. So that's easier.
Yeah, we learned that from apartments. I mean, apartments, we bought a lot over the years, and our typical buy in apartments was like 1970s, 2-story brick, walk up, no common hallways. But in that, you're going to get, I like the classic HVAC units that have been there for 45 years, or aluminum wiring, right? And then you've got plumbing of all sorts of varieties. And we bought buildings before that had terracotta sewer drains. So it's like, that's from like the 40s and 50s. There's all sorts of older stuff. And like, if you're comfortable with buying it because you know what your remediation plan is for it, then sure, you can go ahead. You can tackle that and put that in your CapEx plan and do it. But if it's a brand new one, or it's one that's like out of your league, you just got to know, like, look, that's not my skill set. I can't do that. If we have like a full asbestos remediation, I was like, we're not going to do that one.
I think for new investors, one of the mistakes I made was on my first deal was doing it was getting into something that was over my head. It didn't have anything like this, asbestos and stuff. But it was one of those things that it was like, if you don't have a team and you don't have the know-how for it, you really put yourself at a huge disadvantage. And it's something like, unless you have a partner that's done it for many, many times over and over, and then bringing them on with you, that's a different situation. However, I mean, these are very expensive and very time sensitive as well.
It's one thing if you want to risk your own money, you're going to do it. You're going to try it. As soon as you're going to take on investor money and you're going to risk it, and it's your first time, it's like, you're just amping up the risk factor there a little bit. So I was a big fan of better go try it on your own first, and learn as much as you can with your own money, and then go from there.
Yeah. I always say it to people, and people don't like that. They like to get in and with other people's money, which I feel is completely dangerous. That's where we are living today. I turn down more coaching students that way. I think they turn down themselves if I speak to them. I don't really do that much coaching, but when I do, it's one of the first things I talk to people, and you'll just be like, nope, this isn't going to work. You know what I mean? You're just leaning back of your head. You're like, this isn't, like, this person is already trying to raise money because they don't have any money. And yeah, that's not how I feel you invest into real estate.
Yeah, and a lot of it sticks. I mean, I had a job for a long time too, that I tried to live as efficiently as possible and save as much money as I could so we could, buy stuff and get started. It's not the glamorous route of doing it, but the route that I thought was most appropriate.
Yeah, I think a lot of people that are successful have gone that route as well. So let's talk about money and how you're doing it, because other thing you said too is when you're explaining your criteria a few minutes back, you're talking about buying vacant properties, which obviously it takes a unique financing and debt strategy. So can you tell us a little bit about how your deals are usually structured? And then maybe also how that's changed over the last few years. Obviously, we know about the increase in interest rates, which probably make it a little harder for some of your deals to pencil.
Yeah, it's definitely been a wild couple of years here on how the whole deal structure plays out. But for the most part, our structure from a how do we get compensated and work with LP investors on something? We always have a preferred return. We split the upside. It's all cash based. We don't do waterfalls. We don't do IRR stuff. We just try and keep it simple. We do a single asset at a time. We don't do funds. More time that I look at what we do is more like, oh, well, here's all the stuff we actually don't do. And that leads into, what we do. But we do one deal at a time, and it's just cash return based. So, but when we're looking at that one deal, we are applying leverage. We are mostly working with local and community banks or credit unions on a deal that's in their area. So they can, they're going to all this stuff. They're seeing it. We're typically lower leverage. We're in the 50% range of going into stuff. So that's nowhere near as juicy as it was when it was like, hey, you're going to get an 80% plus loan at 2%. That certainly doesn't exist in any capacity of any kind. It's in the 6% range. 50%. There's definitely going to be some personal recourse in there right now. If you're working with a bank, maybe you could use some debt funds where you're going to be paying in the low to mid teens, and they might not have personal recourse on it. But to get a deal done right now, it's pricey on the debt side, and banks are very stringent to work with, I would say, on what they are willing to do right now, especially when you're like, hey, I've got this great vacant building and want you to get excited about this thing, and we're going to occupy it. Thanks. So I'm like, it doesn't sound so great right now sometimes. But that's been our business plan for 20 years has been buy something that's underutilized or not taken care of, or, has not maybe a physical issue or maybe an operational issue that we can improve and stabilize it. So that's always been our go-to investment strategy, just finding different assets we can do it with. So we've built some very longer term bank relationships that we've been using over the years to facilitate that.
Yeah, I love that idea of working with utilizing local banks and credit unions. I've had a lot of success working with those type of institutions in the past, and mainly working out unique deals and financing structures that typically wouldn't be available for certain deals. And I find that when you're working with one of these local institutions, they know the area. They want to invest back into the area. You know what I mean? They've probably driven by your property before. And the other thing too is that it's very small credit committees making decisions that are local. Everyone's local. You know what I mean? And that's what I have found, that it's great for investors. The other thing too is if you're going direct to them, and it's not that difficult. I was refinancing property years back, and you reach out to a bunch of them, and it's so hyper local when you're working with local banks and credit unions. I would speak to someone. I remember one time that was like 45-minute drive away from the property, and they were a little like off put about, why are you contacting us? And you're like, okay, now I know that this is like, everything's super local. So now, like when I'm making who I'm calling to get property finance, I'm calling like 15-minute drive. You know what I mean? Like, give me that radius and you're going to call it. But tell me about like what kind of benefits you've had for buying. I mean, these are unique properties you're buying, and they don't have cash flow from the beginning. So, I mean, this is going to be something where there's a runway before they are profitable, even though you've done this before. I mean, there's always, a little bit more risk versus, hey, we're buying a property and it's 92% occupied and stuff like this.
Right.
What have you found kind of like of some of the main benefits other than working with these institutions that are local versus kind of going through a broker or going through maybe at regional banks or stuff like that, if they would even lend on this?
Right. Yeah. And just because you've done it in the past doesn't necessarily mean it's going to work this time. There's no there's no guarantees in any of these deals. So, but we do have a local relationship. We're able to be like, hey, come out to the property. Let's walk this together. Let me bounce out, like, this is what we're thinking we're doing here. What do you think? What's your experience showing? What are your other customers telling you, and how the real estate market's working? And a lot of times we get good feedback on that. I mean, a lot of times we'll have those meetings and go through that walk and then not do the deal. Right. And it's like, we learn more as we go through that process and work with them. So I think if you're going into this stuff, you always got to be open to what can I learn from each one of these interactions that I have. What can I learn every time I go walk a property and brainstorm how we're going to do something here? That's really hard to do if it's just an email exchange and the person's in Portland, Oregon, and that's going to be a lot harder to convey what's actually going to happen on the deal. What
do you think when you're, you said before you don't really, you're pretty much building out the units and the space, depending just how the building is versus kind of like on a tenant improvement type, what the requirements are. Is that correct?
Correct. Yeah.
So how does that affect when you're having conversations with kind of any kind of brokers or anything like that? Is that just kind of like, this is what it is? And then anything else where like tenant improvements, that's kind of like something we're not doing, or that's something that you're bringing yourself, but like, this is the shell we're giving you?
Yeah. Well, I mean, we definitely do a lot of tenant improvements. So that's kind of like, step two. Step one is, how do we get the size of the suite built? And, there's different support beams going through the buildings. We're not going to move that stuff. But when we meet with the code enforcement and we're putting up fire rated walls, like, we're trying to do those as efficiently as possible, and like within the boundaries of what can be done at a building. We're not trying to like reinvent the wheel with these spaces and like totally morph how the building works. So if you imagine a building, you already have the support columns that are in there. That's where the wall is going to go. And sometimes that means it's 7,000 square feet. Sometimes it means 4,000 square feet, that suite that goes in there. But we're going to start with that, just because that's the most efficient way to get the space to what we call a white box situation. Where then when we talk with a potential tenant, there is definitely going to be some build out. Some of the larger national tenants, like, they have their plan, they know what they're doing, and they're many times just bringing their own contractors as well. And we're pitching in for the TI. Other times, if it's a smaller operator, even like less than 100 unit franchise operator, they'll look to us to supply the manpower and do that build out, which a lot of times then we're splitting that cost and in some form as we negotiate that lease. But that's step 2. Doing all the TI is definitely a part of it.
How are the leases for something like this? 5-10 years?
Typically like 5 to 7 years. We're not really seeing a lot of 10-year leases. It's more 5 to 7 is our standard lease. I mean, there's built-in normally renewal options and language that goes into that. But 5 would be like our bread and butter from a time standpoint to do something.
Yeah, that's nice because you do all this up front and now you know that you have a pretty solid payment coming in there over the next 5 or 7 years, whatever it is. And I mean, that's kind of like it's everything kind of pays off at that point, which is different from residential where you're having these conversations literally every 10 months with tenants about trying to keep them to stay. You know what I mean? So pros and cons of, different asset classes.
Yeah. I mean, multifamily, you're constantly cycling, but on the other standpoint, most of the time, if you have a 100, 200 unit property, if someone does leave, it's not a big hit. If you have a 50,000 square foot building and 5,000 square feet leaves, all of a sudden you're down to 90% occupancy or 80% occupancy, right? You can take a hit quicker on that one, but you got a 5-year period.
Yeah, no, that makes perfect sense. So Dave, as kind of we're wrapping up here, one thing I like asking is, what are some common mistakes you see, let's say office real estate investors make or real estate investors in general make over your years of being active in the space? Most
of the time it's like, when you get into something you're just not comfortable with. That's, when we look at like the deals we'll buy, even on the multifamily side, we know down to like, this is what we do and this is what we don't do. On the office side, it's like, look, we really want single story 4+ parking spots per 1,000 square feet. We want strong power. We prefer a rectangle sized building. Like we know what we're looking for. If we deviate too far from that, you get into some things you may not have as much experience with, but also you're operating the stuff in most cases, or someone's operating it. We believe in the model where we operate, and our team has to know what they're doing. So if we hand them a brand new fresh problem that we don't have any insight on, it's going to make it really hard. And we're all for learning and experiencing new things. And if you're in real estate and you're operating stuff, there's always going to be a new challenge every month. You're like, wow, learning something this month. That's definitely going to happen, but you don't want to try and learn a bunch of things every month.
No. That's a good way of putting it.
Yeah, it's like, it's fine learning, but let's try and not like learn all sorts of new stuff every month.
Yeah, I like that. Over the years, I've realized the more serious real estate investors, when you ask them, it's very simple to kind of suss out the real estate investors is when you ask them kind of what they're buying or what they like seeing. It is very detailed. It's like in a box that works for them versus someone that's like, oh, we're just buying in like this area or something like this. Or like, we buy 1 to 100 unit buildings, you know what I mean? Whatever it is. When you have people that are like, they get it down to like, it's 10 to 22 units and it's this and it's that and 50 or whatever it is. When it's like so succinct and detailed, then you're like, oh, wow, that's like a real serious buy box that they have, you know what I mean? That they've obviously had a lot of experience with that's worked for them.
Yeah. And even in the buy boxes that we have right now in the first quarter of 2025, there were only like 3 deals that came up that fit any of our buy box criterias, not from a price standpoint, just from like what the physical asset is. Right. So price irrelevant, like what's coming up that fits in our very specific buy boxes. There weren't that many things. So we looked at all the deals that came up, which was 3. We didn't buy any of them, but we'll keep looking and growing and try and find like, is there a new buy box we want to add to it? But that takes some. We're not just jumping into anything on that side of it.
Yeah, that makes sense. Well, Dave, thank you so much for coming on today. How can our listeners learn more about you and Greenleaf Management?
Yeah, best way is really LinkedIn. We post our newsletter every quarter on LinkedIn and my contact information up there as well. And always love talking about what's going on in real estate and what the trends are looking like. So happy to chat with anyone new too.
Well, thank you so much, Dave. Looking forward to connecting with you here in the near future. And we'll put all those links down in the show notes for all of our listeners.
Great. Thank you. Enjoyed it.
Thank you. Hi, guys. It's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars LLC exclusively.